Hello, I am Lindelwa and I am pleased to be seated here with the Chief Investment Officer of 10x Investments. Anton has over 20 years of global experience in asset management as well as growing businesses. Anton, a pleasure to be with you this morning.
Thanks, Lindelwa. Great to be here.
Anton, now, as you know, I'm on the retail side of the business and I speak to customers quite a bit. And what's been coming up is that our customers are uncertain and they're anxious, when it comes to their investment. We as 10x Investments say we believe investments should be accessible and simple. What do we mean by this?
Well, Lindelwa, this industry has a phenomenal ability to complicate things, doesn't it? Very complex use of jargon, etc. And in the end, actually, it doesn't have to be that complicated. In a sense, what we try and do is simplify things as much as we possibly can. And that really means that we want to offer as limited amount of products which serve our clients' needs. Did you know in the industry there's 1,700 unit trusts on offer in South Africa? That's almost 4 times more than there are stocks in the local market. So it really is a world of lots of products, lots of different choices, and that creates a lot of confusion and complexity. So from a 10x perspective, we believe really what you need to do is ultimately access a limited number of products which give you really diversified returns and as much simplicity as possible. So we try and stay away from the noise. We focus on long-term strategic asset allocation, which is the major driver of returns. We try and ensure that we have a lot of diversification in the portfolio. And then finally, we're obsessed about costs and fees. In the end, these are the major drivers of eroding returns. So really those 3 things alongside, providing limited amounts and very focused choices, how we drive through simplicity and accessibility.
Interestingly, you actually wrote an article in February in the Business Day about how 2022 was going to potentially be a difficult year. Now, what are some of the trends we've seen in the market and in our industry?
Well, yeah, I think it's been very difficult. Here we came out of 2 years of COVID. What a relief. And then we've had 2022, which has been incredibly challenging. Obviously, we've seen massive shifts in geopolitics with the war in Ukraine. But really the major thing which has happened this year, which is the game changer, is inflation. And for the first time really in decades, we've had significant increases in inflation globally. We saw in the UK, for example, inflation of 10%. The last time we saw that was in the late 70s during the oil crisis. And this has been everywhere. In the US, we've had the same type of thing. So global inflation, in the middle of this year, got to 8%. A lot of that was driven by a big pickup in food and energy costs, and we felt that everywhere. The consumer was massively being squeezed across the globe, and in particular in South Africa. So what that led to is an increase in interest rates. We saw here locally the Reserve Bank increasing rates by about 3.5%. That took us back to the level that we were at pre-COVID. But we've lived with high interest rates for a long time in this country. We know what that's all about. However, in global markets, that's not really the case. In the US, where rates are now up to 4%, that's from 0 at the beginning of the year, and that's the highest rate we've had in nearly 15 years. So it's very different globally than it is here locally in that sense. And the reason why that's important is that ever since 2008, which is the last time we had rates at this type of level, global debt's gone from $160 trillion to over $300 trillion. So what 0 rates and QE created was an environment whereby we were able to create lots and lots of credit in the system. And just to talk a little bit about QE, and QE quantitative easing can be a complicated economic tool. But really to simplify it, the way I kind of like to talk about it is QE in a sense is whenever we've had problems in the system, so markets are under pressure or the economy is under a bit of pressure, central banks, let's just use a different way of comparing this, let's use an alien ship, would come down to earth and say, right, there's a problem here, we've got lots of dollars in our ship and we're going to buy up all of your securities. So what we were able to do is that every single time we had any wobble in the system, we printed money. And we created free money in the system, inflated asset prices, and we were back into kind of a very low volatility environment. That's been 15 years. I'm really simplifying it. That's been really what's happened since the financial crisis. Inflation changed everything. Because really what that meant is that the ability of the central banks to do that is now being constrained. In fact, they have to go the other way because the pressure is being politically around how do we contain inflation. So 2022 is a game changer in many ways, geopolitics, for one, but but most importantly, the biggest change has been this massive increase in interest rates on the back of inflation. That's why we've had the volatility, and that's why we've had, total returns in bonds and equities and global markets, being under pressure.
Wow, that just did feel like an Ecos 101 lesson there. Thank you, Anton. So now, bringing it closer to home, South Africa hasn't been immune to what's been happening globally, but when we look at our very specific economic, social, as well as political climate, things haven't been, great for us. And what has been the impact then, on the JSE, our local returns, bonds, as well as our very own high equity fund, which we've recently renamed to the 10X Your Future Fund? What has been the impact on that?
Yeah, well, a lot of impact, but I will say one thing. When we wrote that article back at the beginning of the year, we made a couple of points, and one of which are relevant for the local market. And one of the key points was that reference I made to higher interest rates being prevalent in the South African economy for decades now compared to global markets. So what that's meant is we haven't actually inflated asset prices yet. We haven't run very loose policy. We've actually run a very conservative monetary and fiscal policy, particularly in the last few years. And so that meant we didn't have these inflated asset prices. We had bond yields at 10, 11%. Real yields were, actually the most attractive in global markets. So, when we went into this, there wasn't an asset bubble as such in the South African market. It was actually a functioning market, wasn't kind of distorted by central banks. So we made the point that, sure, it's going to be difficult, it's going to be volatile, but it won't have as big an impact as what we're seeing in US equities and US bonds, and that has turned out to be the case. So if you look at the local equity market, we, roughly flat year to date, down 6 or 7% in dollars. Our global bond, our SA bonds yields have gone up by a couple of percent, but total returns have been positive. So if you kind of frame that relative to what you've seen in the US, where equities are down 17%, US Treasuries are down, total return 13%. Our returns have actually held up really well, and overall our funds have generated positive returns. So that's really the first point in terms of the local market. The other change, which has obviously been a big deal for us, is what's happened with the changes in Regulation 28, in particular around offshore exposure, which we've been gradually increasing here locally over the years. And the limit was previously 30%, and now we've gone to a limit of 45%. So a significant change in the retirement market here in South Africa. And we've taken that opportunity to increase the 10X Your Future Fund now from below 30% to 39% over the course of it. So that brings a lot of global diversification into the portfolio.
Yeah, that's quite good news actually for the 10X investor. So we've spoken about what's happened in 2022. What can the 10X investor or investors at large, expect looking forward into the future, Anton?
Well, definitely don't have a crystal ball. I think that predicting outcomes is a very risky business, and it's not something that we really believe is a great way to construct portfolios. But at the same time, don't predict, but prepare. You've got to prepare yourself for potential outcomes. And in a sense, like we talked about at the beginning of this year, is prepare ourselves for volatility. It really is the same thing going into next year. This kind of removal of this, what they call the central bank put, has meant that this blanket, which has really supported the system for the last 15 years, is no longer there. So the market is kind of left to operate unto itself, and that means more volatility. So the first thing we just have to prepare ourselves for is the volatility we've seen in 2022. It will continue into the next year. And I think the change which we'll see is this migration from higher inflation, and it feels like we're kind of through the worst of it at the point of this year, from higher inflation into one was what happens with the global economy. So it's a very well flagged global recession, probably the most flagged global recession that I've seen in my career. The question is not whether we're going to have one, the question is the depth of the recession that we go into next year, and just how big an impact it has on corporate earnings, how big an impact it has on unemployment, and therefore ultimately how big an impact it has on the economy as such and financial markets. So I think that's probably the most important thing for all of our investors to really prepare ourselves for is volatility. But just going back to this point that I made earlier is valuations have adjusted quite a bit. A lot of global equity markets are at the cheapest levels they've been since the financial crisis. You now have global bond yields actually offering some value. While we have no idea what's going to happen in the next 3 to 6 months in terms of volatility, markets most certainly could go down and probably will. But the reality is, a long-term investor, which we are and our investors are, looking at long-term, the total return expectations are looking actually a lot better now than they were, just given where valuations have got to.
Really getting the sense of optimism speaking to you, Anton. I'm just going to close our chat with a quote and get your thoughts on this. So George Soros says, "It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong." What's your take on that?
I think it's about remaining calm. That's and not getting obsessed by the noise. And it's very hard to do that. I mean, particularly in this country, where there's a lot of noise, there's a lot going on, which can make us very negative about how things are going to play out. And I understand that. But it's really just about kind of thinking long term, and ultimately as an investor, continuing to save for your retirement, continuing to save for an outcome, and continue to add to that investment that you have. You're never going to time markets perfectly. I've been in this industry a long time, and timing markets is really difficult. So the sense of remaining calm, remaining invested, are kind of key elements as to what we believe is crucial for success in saving for your retirement.
Well, there you have it, Mr. Anton Eser, the Chief Investment Officer of 10X Investments. Thank you.
Thanks.